Welcome back, dear learners. Before the ad break, we were able to do equity note. That is note number 7. Now we're going to look at our non-current liabilities. And we're given an extract from the pre-adjustment trial balance of Brixton Suppliers on the 31st of December. We have capital, we have the loan from Store Bank, and then we have interest on the loan. Let's see what more we are given. It says, interest on the loan from Store Bank has not been entered yet. That is in the business books. Interest is capitalized. The loan statement received from Store Bank reflected the following. There is the statement. So we have balance at the beginning. Remember, our financial year is ending in December. So this becomes our balance at the beginning, and this becomes our balance at the end. Note, the repayments of the capital portion of the loan will remain constant in the next financial year. So what we can do here to make it very easy, we can open a loan account that will allow us to understand how our loan is going to be repaid. Okay, so here is our loan account. Loan is a liability. That means it increases on the credit side, plus, and on the debit side, it decreases, minus. And we are told that the balance at the beginning was 270,000. So I'll come here and I'll have my balance brought down. Here's my balance brought down. That is my balance at the beginning, 270,000. And we would then record what is known as interest. We are told that interest is capitalized. So once interest is capitalized, I will credit that interest then. But in this case, I don't know how much is my interest. It's still not a problem. When I make repayments, it will decrease the loan. So I'll come here, then I'll say the repayments, then I'll say bank here, the repayments. And my repayments for the year are 85,000. So I'll come here, then I'll say bank 85,000. I am told that at the end of the year, my loan balance is 235. That means if I come here, and here I'm going to have my double lines, all right? Here I'll have my double lines. At the bottom here, I'm going to have my balance brought down, 235,000, the loan at the end. That balance brought down must be balance carried down here then. Then I come here, it is balance carried down. And the balance carried down will remain again 235,000. Okay, so for it to be brought down here, it had to be carried down first. Okay, so it's carried down, then brought down. 235. Now, I still need to get my interest. So I'll say 85 plus 235. That will give you 320,000. 320,000 here. So I'll come this side and I have my 320,000 here. Then I'll now say 70 plus my interest here, which is unknown, will give me 320. I'll say it again. 270 plus my interest, which is unknown, will give me 320. In other words, if I say 320 minus 270 gives me the interest, which is unknown. And if I punch in my calculator, 320 minus 270, the difference becomes 50,000. That becomes the interest. So I have completed my loan account. I am told here, note, the repayment of the capital portion of the loan will remain constant in the next financial year. Whatever we paid for the capital portion of the loan, we will pay again the same in the next financial year. What that means is, in this 85,000 here, in this 85,000, we have paid for two things in that 85,000. Number one, we have paid for interest. Interest I have been given 50,000. Interest is 50,000. Very simple. But we have also paid for the loan repayment. We have also paid for the loan. And if I paid 85 and 50 is interest, how much then is the loan? That is 85 minus 50. Therefore, it becomes 35,000 here. 35,000 becomes the loan repayment. 35,000 becomes the loan repayment. Once I understand that, it becomes easy for me to know that in the next financial year, I am going to pay a loan of 35,000. Why? Because they said the capital portion, which is the 35,000, will remain constant, whatever we paid. Remember, in the 85, I have two amounts, 50,000, which is interest, plus 35,000, which is the loan repayment. So they're telling me that in the next year, I will pay again that 35,000. Once I have that information, I know that my loan is a non-current asset. That means, a non-current liabilities, not asset, a non-current liability. My loan is a non-current liability. I know that once I have a non-current liability and I'm going to pay that liability within the next 12 months, it will stop being a non-current liability and becomes a current liability. So the part of the loan that I will pay within the next financial year will then cease to be a non-current liability and will become a current liability. So there is my loan account. Then I'll then come here and I'll say, on my loan, which is from Store Bank, the amount owing at the end of the year is 235. I know that within the next year, I am going to pay 35. How do I know? Because within that 85, there is first 50 and there is also 35. That is what makes 85. And that 35 is the capital portion of the loan. And then the 50, remember, that was our interest. That is why if you come and say 270 minus 35,000, it will give you 235,000. So that means on the loan this year, we only paid 35,000. So I can come in and say 235. I'm now thinking of the next financial year, 235 minus the 35 that I'll pay in the next financial year, minus 35. That will give me 200,000. Then that 35,000, I'll bring it down here and record it as short-term loan. 35,000. Others will call it current portion of loan. Still the very same thing. Current portion of loan, or you write short-term loan. It is that portion of the loan that we're going to pay within the next 12 months. So we take it out of our non-current liabilities and we bring it to our current liabilities. That is what we then do. There it is. Dear learners, this is how we would record our non-current liabilities. Remember that loan would show the 200,000 and then the short-term loan becomes 35,000. Thank you so much for joining me in today's class. I hope to see you again soon. It is goodbye.